price ratio of Ethereum to Bitcoin is really the most important to watch. And if Bitcoin gets to 250,000, which is our view, and Ethereum trades at its 8-year average ratio, that's 12,000 Ethereum. If it gets to the 2021 high, that's 22,000 Ethereum. We believe Ethereum is, because it's the future of finance, well, it's going to be a payment rail that gets to 62,000 Ethereum. But what if Bitcoin gets to 1 million? That would value Ethereum at $250,000.
Tom Lee begins by highlighting a striking empirical observation. BitMine's stock price closely tracks the price of Ethereum. When plotted on a chart, Ethereum's price sits on the x-axis, while BitMine's share price sits on the y-axis. Looking at the data since July 10th, the relationship is clear. As Ethereum rises, BitMine rises almost in lockstep. Using a simplified regression, Tom Lee explains that BitMine's share price can be roughly estimated as 0.055 x Ethereum price plus any additional Ethereum per share accretion occurring at the company level. This means BitMine effectively behaves like a leveraged equity expression of Ethereum. It is not a perfect one-to-one proxy, but the directional and proportional relationship is strong enough to warrant serious attention, especially if Ethereum enters a multi-year structural uptrend. Before we go on, just a quick reminder, liking the video, subscribing to the channel, and commenting helps this reach more people who care about Bitcoin and macro trends. Appreciate the support. Let's continue.
BitMine's stock price follows the price of Ethereum. So on the x-axis here is the price of Ethereum. The y-axis is BitMine's share price, and this is since July 10th. And as you can see, as Ethereum's price has moved up, BitMine's price has moved. The coefficient in this, it's a rough equation, is roughly 0.015 times the price of ETH plus whatever ETH per share accretion is taking place. Now, keep in mind, Ethereum, in our view, is the future of finance. Larry Fink even wrote about how tokenization is really the biggest innovation in financial market infrastructure since double ledger accounting. And he thinks we're at the beginning of tokenizing all assets. And the good news is most of this is taking place on Ethereum. Look at the number of Wall Street institutions building on Ethereum, and look at the total value locked. The majority of this, vast majority of this is happening on Ethereum. And we've talked about this. This is why we think the price ratio of Ethereum to Bitcoin is really the most important to watch. And if Bitcoin gets to 250,000, which is our view, and Ethereum trades at its 8-year average ratio, that's 12,000 Ethereum. If it gets to the 2021 high, that's 22,000 Ethereum. We believe Ethereum is, because it's the future of finance, well, it's going to be a payment rail that gets to 62,000 Ethereum. But what if Bitcoin gets to 1 million? That would value Ethereum at $250,000. So you can imagine, let's take this chart again, that BitMine's price follows Ethereum's price, but then let's look at the future price levels for Ethereum. 22,000, 62,000, and 250,000 Ethereum. Well, using that coefficient, that would put $500 BitMine share price at 22,000 ETH. At 62,000 ETH, 1,500 is the implied price for BitMine. And of course, at $250,000, the implied price for BitMine is $5,000 a share. Now, of course, this is per share levels. These are implied from using Ethereum's price in that coefficient. But here's the thing, not everybody wants a stock price at 500 or 1,500 or 5,000. Most people want shares to stay at around 25. So what would be the required split to get BitMine's share price back to 25? 25 means it's easier to buy lots of shares at $25 a share than at 5,000, for instance. Well, here's the numbers. At 22,000 ETH, the stock price would have to split 20-1 to get back to 25. At 62,000 ETH, the stock would have to split 60-1, and the implied split at 250,000 ETH is 100-1. Well, what does that mean? As you can see, the current shares outstanding is 426 million, and we're trying to get the authorized share count to 50 billion. That doesn't mean we're issuing 50 billion shares. That's what we want the total max shares to be. Well, here's the math. If you split 20-1, the current share count would go to 8.5 billion. If you split 60-1, the share count goes to 26 billion. And if you split 100-1, the number of shares goes to 43 billion. So you could see it's going to be important to increase the total maximum authorized shares. So going back to this question, why does the company need to increase authorized shares? I think the most important is to accommodate share splits.
As of January 1st, 2026, the total cryptocurrency market capitalization sits at approximately $2.97 trillion. At first glance, that number might sound large, but when viewed through the lens of Ben Cowen's fair value logarithmic regression trend line, the story changes dramatically. According to this long-term valuation model, the fair value of the crypto market is closer to $4.6 trillion. That implies the asset class is currently trading at roughly a 35% undervaluation relative to its historical growth trend. In other words, despite all the headlines, ETFs, institutional adoption, and technological progress, crypto as a whole remains structurally undervalued. But there's an important caveat.
As of January 1st, 2026, the total cryptocurrency market capitalization is coming in at around 2.971 trillion, with the fair value logarithmic regression trend line quite a bit higher at around 4.6 trillion. This still represents an undervaluation of approximately 35%. But this entire cycle, as we've said, is mostly driven by Bitcoin. So the overvaluation phases that we typically have gotten that normally occur in post-halving years did not happen in this post-halving year. And you could argue it was because of monetary policy. You could was it quantitative tightening? Was it high interest rates? Was it because people were just tired of getting scammed out of all these different meme coins? Who knows? But we didn't get that rally above the fair value logarithmic regression trend line that was sustained. If you look at, say, the 2012 rally, after Bitcoin broke through the fair value logarithmic regression trend line and went into this first peak, we actually saw a lot of altcoins back then in 2013 start to do really well. Not that there were many of them, but many of them did well in that time. And in the next cycle, it was mostly Bitcoin driven through 2015 and 2016. And then once we got into 2017, that's when many of you will probably remember the altcoin season of 2017, where we had the ICO craze. And so what started off as a Bitcoin-led bull market, Bitcoin then handed it off to the altcoins, where the altcoins made us go more into overvaluation territory, which then led to this major crash. And then in the 2017, 2018, 2019 timeframe, we fell back down into being undervalued. We then rode that fair value logarithmic regression trend line for a while. And then once we got into 2021, we had an alt season and the asset class went overvalued for a while. This cycle started off as a Bitcoin-only bull run in 2022. It continued as a Bitcoin-only bull run in 2023, continued as a Bitcoin-only bull run in 2024, and then potentially found a top in 2025 without a rotation into altcoins. So let this be a lesson that there is never any guarantee about what the future may hold. You could get an alt season at some point in the future, but it's not justification for holding altcoins for years, as they just simply bleed to Bitcoin. In order to get an alt season, Bitcoin has to go durably overvalued. That euphoria has to come in. All the top indicators have to start going off. That is what leads to the rotation. That's what leads to the more durably overvalued regime. But until you get there, you're better off with Bitcoin. Because as we've said forever, Bitcoin leads the bull market. And until euphoria happens, Bitcoin is probably going to be the better play. That doesn't mean you're not going to have periods where dominance goes down, but Bitcoin continues to be the better play year after year after year. And as I showed in a recent video, if you look at all Bitcoin pairs, they actually have gone down 4 years in a row. So remember, the future is not promised. Just because an influencer confidently tells you that alt season is going to happen around the corner doesn't mean it's actually going to happen. Okay, so going into 2026, a lot of lessons have been learned from the last cycle. Don't forget them. A lot of good investing principles can be taken by all of us, right? We've all learned things this cycle. Consider it your tuition into the cryptoverse. Don't beat yourself up over the losses from some altcoins you bought. I've lost plenty of money on random altcoins throughout the last, many years. Maybe not this cycle, but in prior cycles, I've lost plenty of money on some of those random altcoins. So don't beat yourself up. It's the tuition that all of us pay into the cryptoverse. Now use that to become a better investor going forward. The reality is that, you know, if you do constantly peddle alt season to a lot of people, you're basically just shilling the equivalent of penny stocks and telling people why penny stocks are better than buying the blue chips. And that's not a good strategy long term. It really never has been, and I don't think it ever will be. That's the important lesson that I think we can all take from this. So, we spend years undervalued, we spend years overvalued. This cycle, we've mostly been below that fair value logarithmic regression trend line. We poked our head above it a few times in 2024 and then in later 2024 and 2025, but it always mimicked 2019, where it didn't quite get us to where we wanted to go. I believe right now we're in this phase. We're just kind of bleeding down as QT has come to an end and QE has begun. It's just not enough yet to justify the next bull market. At some point we'll get there, just not sure that we're there quite yet. If you take the percent difference between the fair value and the total cryptocurrency market capitalization, you get a chart that looks like this. And what it shows you is that whenever we get down here to this 50% undervalued or whatever, it tends to end up being a great time to accumulate crypto for the long term. So just keep that in mind throughout this year and in future years, that the major euphoria peaks are not promised, but in these areas down here has historically been a good time to get into the cryptoverse. And my guess is that we will revisit those levels in 2026. Ultimately, I do think the entire asset class will go to $10 trillion, plus or minus a few trillion. And as we go to sleep at night, we cannot help but wonder, what's a few $1 trillion among friends?
As we move forward into 2026 and beyond, the most important lesson from this cycle is simple. The market does not promise euphoria. It does not guarantee altcoin seasons, and it does not reward impatience. Bitcoin has once again proven why it sits at the center of this asset class. Until genuine euphoria returns, it will likely continue to lead. We will spend years undervalued. We will spend years overvalued. And somewhere between those extremes lies the opportunity. If this cycle taught us anything, it's that discipline matters more than narratives, patience matters more than predictions, and understanding valuation matters more than hype. Because in the long run, the crypto market may reach $10 trillion, but how you position yourself along the way determines whether you benefit from it. And after all, what's a few $1 trillion among friends?